Hello everybody, welcome to the core content lecture. This one will be focused on a deeper dive into reversion levels. So getting started, looking at the diagram, as many of you already know, I shouldn't have to explain this to you, but this is the typical TPD visual. So as you can see, we have a cracking correlation between the close of this candle, which would be candle 1, and the opening of this candle, which would be candle 3. Vice versa, for if this were another asset, the close of this candle is higher than the opening of this candle. Cracking correlation, which gives us an insight that candle 3 on this asset right here is likely to run below candle number 2's low in a bullish environment, creating an SMT with candle 2 and candle 3. So I'll say that one more time. If we were in an environment that price was pre-exposed to already being bullish and a TPD forms, the asset that has the higher open on candle 3 is likely to create a failure swing on candle number 2, meaning it is stronger trading in the bullish direction, while the asset that creates a lower open, which would look like this, is likely to run below candle 2, is likely to run below candle 2's low, creating an SMT. So you're probably wondering, well, how does this connect to reversion levels? Well, if you know which asset is likely to be stronger in a particular direction, for example, if we were bullish and the narrative was bullish and a TPD formed, we would look for a reversion level specifically in the stronger asset as it creates a failure swing under candle 2's low, and we look for the asset that is weaker to run below candle 2's low, creating an SMT, which on the lower time frame would look like this. So in candle number 2, we have that reversion level, and we have that change in the state of delivery forming in the second half of candle 2's lifespan. Candle 3 would open up, tag into that reversion level, and then continue the expansion. While on the asset that is weaker, it is likely to run below the low of candle 2, creating an SMT, and then continue higher. Now, whenever you're comparing three assets, the one you want to choose is the strongest one in the direction you're expecting price to expand towards, and you're trying to enter inside of that reversion level to encapsulate the expansion. And to prevent getting stopped out or getting wicked out from the SMT, you always want to choose the stronger asset. Generally, more times than not, if you follow with the time frame alignment and the order of operations, which was shared in the previous reversion level lecture, you will see this phenomenon happening. But if we look a little bit closer into the depth of reversion levels, typically the price action beforehand will have a small phase of an accumulation and another small phase of accumulation. So a high probability reversion level will have generally a tight consolidation and then an expansion, and then one more consolidation again, and then another expansion, finally creating that reversion level, with having the TPD tipping its hand that a reversion level is there. That change in the state of delivery will occur, price reprices inside of that reversion level, and then candle 3 expands. After the expansion, the typical characteristic of price action is having another small consolidation slightly above the previous consolidation before that reversion level forms. And if you have a fair value gap intertwined with that consolidation, that can be used the same way as the universal model that I shared with you all at the beginning of the year. And then if price expands away from that again, you can use it the same way with this consolidation, taking that across, intertwining it with the fair value gap, price is prone to retracing inside of there, and then continuing the expansion. So now you're probably wondering, what is the takeaway from this? How do I actually see this and identify this? Well, it all comes by means of having the TPD there and seeing a reversion level within there, and then having that change in the state of delivery as well, giving you insight that all of this is likely to occur. If you see a TPD and a reversion level, and then these two periods of consolidation beforehand, more times than not, that is a very, very, very high probability signature for price to create a lower time frame reversal on a higher time frame continuation. But some of you that have been around a little bit longer, you guys might look at this and see this as ICT market maker models, which is pretty much what it is, with the inclusion of reversal levels and TPDs. So reversion levels tell you when ICT market maker models are actually there. True market maker models. If you go back and look at every high probability reversion level that worked and that gave a really nice run on price, you will see the same characteristic. So reversion levels and TPDs act as the vertex of market maker models. But filtering it out and adding something that's required so you know when it's high probability is stacked true opens. So the age-old adage of never buy above the true open, never sell below the true open, that applies with reversion levels and TPDs that tip its hand for reversion levels. So optimal bearish reversion levels will form above the 90-minute cycle and microcycle true open. Optimal 5-minute reversion levels will form above or below the daily cycle and 90-minute cycle true open. 15-minute reversion levels should form above the weekly cycle and daily cycle true open. And optimal hourly reversion levels will form either above the weekly cycle true open and the daily cycle true open. And it's all dependent if you're bearish or bullish. Let's say, for example, you're bullish and an hourly TPD forms with a 15-minute reversion level, then it should form below the weekly cycle and daily cycle true open. So adding that into context with the image, it would look something like this. And yes, you guys can screenshot this if you choose, because anybody that hasn't been through the entire course or the entire process, this would look foreign to them. So hopefully y'all found this one insightful. Enjoy the rest of your weekend.